Well, as you know, it's important to diversify your overall investment holdings to balance risk versus reward or risk versus return. And so that's where you have different asset classes like stocks and bonds and cash and precious metals, maybe like gold and silver and whatever else you might have invested in, the real estate, whatever it might be. You have a variety of asset classes that you're investing in. Now, within each of those asset classes, you want to have a variety of assets within that. Maybe you have some bond holdings. You want to have maybe short-term bonds and medium-term and long-term bonds and maybe government bonds versus corporate bonds. There's a whole bunch of things you can do with just bonds. But this is a stock investing course, so let's talk about stock. So not only is it important to have a diversified portfolio of these different asset classes, stocks, cash, bonds, etc., you want to diversify your stock holdings too, whether they're individual stocks or mutual funds or index mutual funds or exchange traded funds, whatever it might be of your stock-based holdings, your public stock-based holdings, you want to diversify those as well. And there's a variety of ways to do that. Really three big ways that we're going to look at to really diversify. And then within those classes, you can hold a whole bunch of different types of securities or equities or stocks, all mean the same thing, so that you can have diversification within each of the categories. But to start, the three big things you want to look at is how am I diversification? What types of things do I hold in terms of size, style, and sector? And so what we mean by size is probably what you think. How big is the company? Is it a large company versus a small company? And in the next lessons, we'll look at the differences between like a small cap, mid cap, and large cap, mid or large capitalization stock. And what does that mean and how do we evaluate stocks based on their size? Next, we want to look at also how do we evaluate stocks based on maybe their style or style factors like, where do they fit? You've probably heard the terms like growth and income or maybe in value, right? So if it's a growth stock, maybe it's a high technology stock that's on fire and they're growing like crazy. Well, that's a growth stock versus maybe a 100-year-old company that pays a great dividend that might be a value or more of an income type stock. And where does value come in as far as, is it overvalued or undervalued? And is there a way to have a value-based strategy? And there is. Also maybe where they're based domestically or international is another way of style and breaking up the style, whether it's a stock, a mutual fund, ETF, whatever it might be. And lastly, sector. What sector does that stock, is it related to? Now think of it as like an industry, right? So if you're looking at ExxonMobil, a big natural or oil and gas type company, well, they're in the energy sector. That's what they do. Versus, let's say, Coke and Pepsi, which are beverage makers. They do other things too. And that's the thing where it gets a little weird sometimes. You have to dig a little bit, but they're primarily a beverage maker of soda drinks or carbonated beverages. Where I come from, we actually call them pop. So every culture might have a different way you might call Coca-Cola or Pepsi, but they're all within sectors. If you have a bank, that's in the financial sector, and then even within the financial sector, it can break down from there. Or the healthcare sector, you can break it down into subsectors from that. So for example, let's say healthcare, you have healthcare as an overall sector, but then within that sector, you might have things like hospitals is a subsector or a subunit. And then you might have pharmaceuticals, people who make drugs. Drug companies are pharmaceuticals. You have nutraceuticals, which is like nutrient type things and base things around that, or medical devices such as heart stents and valves and things like that that are more of a device to treat people versus, let's say, a pill or a drug like a pharmaceutical company might make. Or how do you do insurance? Maybe you have managed care or different types of health care that might fall under that overall umbrella of healthcare. So, and then there's also things like biotechnology. Or biotechnology stocks and things of that, like Amgen. So there's a lot, even within a sector, that you have all these different subsectors. So if you were to say to somebody, yeah, I'm invested in healthcare stocks, the person should say to you, that's great. Which sector of healthcare are you in? And then you can maybe talk about individual stocks. And some individual stocks might play in lots of sectors. Johnson & Johnson, they do medical devices, but they also do a lot of things in medical around things in the operating room and some things around that. And you probably know Johnson & Johnson from Band-Aids and things that you can buy as a consumer. They make those. So it's very interesting as far as how you can break down stocks. So that's one way to diversify your holdings, is looking at these categories. And we're going to really explore that more in great detail next in the upcoming lessons. But think about if all I own is large cap stocks, well, I might be at more risk than if I had a mixture of stocks that might be smaller, medium versus domestic or international. And maybe I need a variety of sectors too, so I'm not all in energy or all in healthcare. And that's the way you want to diversify your stock holdings as a subset of your overall holdings. So think your overall holdings, stocks, bonds, cash. You have your stock section, diversifying around size, style, and sector. And that's what we're going to look at now. Well, does size matter? Well, it does, at least when it comes to stocks and your portfolio and how you want to build your overall compensation or composition, that is, of investments. And so first thing a lot of people look at is size, big, medium, and small type companies. And it's not really organized that way, really, because you think, well, what is a big company? Does it mean it has a lot of employees? Is it like, in the top 10% in sales? Is a big company something that's very profitable? Or is a big company that has operations all over the world? I mean, there's small companies that might have 10 offices all over the world, but they might have only 40 employees total, really. They're just spread out all over the world. So in the stock market and investing, how do we determine what is a large, mid, or small size company? And how it's done is through a cap or capitalization. It's a market capitalization. So if you're looking at stocks, you might see this little thing in the stock screeners or all that, or around their quote, they're saying, their market capitalization is X thousands, or maybe it might even say like large, mid, or small, like on a mutual fund. It might say like, we're a large cap mutual fund looking at stocks. And then they might break it down further, international, value, growth, whatever it might be that we're going to talk about in a second. But first step, let's look at large, mid, and small cap stocks. And so how this capitalization is calculated is looking at the stock price, what do you pay for one share of that stock, times the overall number of shares that are outstanding or out there that could be publicly traded as far as the number of shares. So you multiply those two numbers together, you get a big number, and you have your share price, right, or your market cap. And then from there, that's how organizations or how like things like mutual funds will break down whether somebody fits in large, mid, or small. And typically the numbers are, once you multiply your stock price times the number of shares, the general cap ranges, or what makes a large cap, are typically like 10 billion, the number would be $10 billion plus, right? So it's your stock price, which is the price per share, so it's a dollar amount or whatever, numerical value amount, but it's a money amount times the number of shares. So large cap is 10 billion. We were use like, US numbers. I have folks from all over the world. I'm very grateful for that. So bear with me as we use US dollar-based numbers for the sake of education here. So we have large cap would be 10 billion plus. Mid cap is typically between 2 to 10 billion, would be considered a middle size, not large, not small, but in the middle, a mid cap stock. And then a small cap would be anything that's less than 2 billion. As far as stock price times number of shares for your capitalization, a small cap or small capitalization stock would be 2 billion or less. And so why that's important is it's really a matter of how you put together your portfolio, right? So if you have a portfolio that's all these large cap stocks, that could be great, but maybe you're missing out on things that are happening in the small and medium area. If you're invested heavily, let's say, in small cap stocks, which tend to be a little bit more riskier than a well-established large cap or large company, but maybe give you a potential bigger return if somebody goes from being small nothing in somebody's garage or a little small company and becomes Apple Computer, for example, becomes a large cap, well, that can be great gains for you. So you want to have a mixture within your portfolio of these different types of stocks, based on your overall portfolio and what your long-term horizon is and what you're looking to do. I mean, if you're looking to have a portfolio that has real heavy on, let's say, paying out dividends, where you get quarterly income, well, that's going to typically almost always come from large cap stocks. They're well established, they got money, they can pay back money, where a small cap person might be like, we're just trying to stay alive and we're trying to invest in the company to grow. Same with mid cap, so we're not going to pay a dividend. So those are things you might want to look at as we go through the course here. So you want to have diversity inside your asset class, so you have stocks, and so size within there is a way to do that. It also helps reduce your overall risk. Let's say large cap stocks have a period of time, and they have, like all asset classes, where they've struggled, while possibly small cap stocks might be outperforming them, or mid caps might be outperforming them over that same period of time. So if all you invest is, let's say, in one asset, like large cap, you're going to ride that elevator up and down within that class, and miss out maybe on things that might be helping as far as with small and medium. And also by doing that, you reduce your risk. You don't have all your eggs, so to speak, in one basket. You're not all in the small cap basket or the mid cap basket. You're in the large cap basket. You're all going to have diversity amongst those asset classes. So, and it also helps narrow your research down too. Maybe you're looking at your overall portfolio and you say, oh, I'm pretty heavy on small cap stocks because they've grown recently and I want to rebalance. Maybe one way to rebalance is I'm going to buy some new stock, and I might want to look at large cap or medium cap or mid cap to try to be myself more in an overall balance. And we'll look at these different types of balance and diversification, but to get an idea of an overall balance of your overall portfolio within the stock section of your bigger overall portfolio. So size does matter, and it really is very, very important. And one thing you see with folks is they might have more creeping or movement towards one area, and it's really good to look at if you've got some stocks or some investments now, maybe some mutual funds, to look at what you have and look at it from these three factors and say, wow, am I really over-invested maybe in a particular size? And it might be an opportunity, as we'll learn in the course, how to pick out stocks and mutual funds and ETFs and index funds and all that, to maybe apply these principles to say, oh, let me maybe now invest in this other size of asset class. So that's one way to do it, is looking at size. Now we're going to talk about style and sectors. So you can evaluate stocks based on your overall portfolio and your stock portfolio on size, large, mid, or small cap stocks. And then any of those stocks, whether they're large, mid, or small, can be evaluated based on their style. Are they a growth stock? Are they more of an income stock? And income and value stocks are very related, a little different. I'll explain why here in a moment, so hang on to that part. But we're going to talk about growth, income, and value. If you've looked at, let's say, mutual funds, you might see like a little square box with all these little squares inside it. There's like 9 squares in it, and it might say things at the top for a stock mutual fund. It'll say, or on the side, depends where they put it, but it'll say like growth in value or growth and income on either end. And really what they're looking at is the style of that stock. What is it related to in terms of other stocks within that style type thing. So Coca-Cola, for example, is a different style stock than, let's say, Google. Doesn't mean they're not successful companies, one versus another, both very successful companies. Just how they behave and some things you might use to evaluate them, whether you want to invest in them, might be different between the two. So let's take a look at that. So first, let's look at growth stocks as compared to income or value stocks. So growth stocks, think of those as you're looking for growth. You're looking for the price of your stock to go up, or capital appreciation. You're looking to make money. You're looking for your capital to grow. And so these are stocks that are projected, or you're projecting, or for these stocks to grow and outgrow and grow faster than the market, and in particular grow faster than their rivals within their industry. Whenever you're looking at stocks, think about the industry. Some industries might be growing faster as an industry versus other industries, so you want to compare within the industry. So growth stocks are all about high flyers, right? They're the high flyers that things look great and you want to see them keep climbing and really reach a peak and then maybe sell high later, but right now you're looking to buy and have that really grow. And the idea is that the earnings are things that drive up stock price in a large way, or maybe later will pay out money or invest money into the company again. That earnings are growing faster than the industry and market. That's one way to basically recognize a growth stock, that earnings are growing faster, typically much faster than industry and market. So if you look at, let's say, some particular ratios or things that people are interested in growth stocks look at, they would be interested in things like along the lines of revenue or sales. Are your sales and revenue growing? How's your cash position, your cash flow? Do you have a good flow of cash coming in? Are you running, are you running below? Are you incurring lots of debt or something like that, and you don't have the cash to support that? So looking for cash and revenue that are rapidly rising is typical of a growth stock. They would have a higher price to earnings ratio. What's our price relative to our earnings as a comparison, as a ratio? So these would be high price to earnings ratio, higher than their industry, probably higher than the market. And then a higher price to sales. You're paying for those sales. You're paying a high price. And when I say price, the stock price. So higher price to earnings would be the stock price to its earnings. This would be higher price, the stock price in relation to its sales as a financial ratio as a measure to compare, let's say, an individual company versus others as an example. So you can see the trend here. It's all about high, all about growth, all about, yeah, I might be paying a lot for the stock, but that's okay because it's going to keep growing and it's going to be great, And that's the idea, is that it's investing in the company to have that future growth. So typically growth companies, if you're interested in dividends, or companies that pay out money directly to you in terms of cash, maybe on a quarterly basis, a quarterly dividend where they're taking their earnings and rewarding you as a stock owner, rewarding you as an owner in the company, a part owner of the company. Growth stocks typically don't pay a dividend because the idea is they don't want to give you that money as an owner, and you should actually not want it. And here's why. They want to reinvest that money into the company because the prospects look so great that we want to keep reinvesting to grow that company. So the management of the company will say, we don't want to pay out that money. We need that money to invest in things like research and development, or research into quality control, or research into new markets, or maybe into mergers and acquisitions, and buy new companies or buy smaller companies to help fuel our growth. So it's all about fueling the growth. So typically they won't pay a dividend. A good example of a company like that is one you're very familiar with, is Google, right? Look how the explosive growth of Google, certainly of its stock price from 10 years ago or 8 years ago, whatever, how it's rapidly growing. A very typical technology stock. Technology stocks a lot of times will be growth stocks because you're investing in them with the idea that they're going to invest in new technology and build new technology and build crazy things like self-driving cars and all that that'll change the world. And when that happens, then their stock price will go up and you'll be rewarded for your patience as a stockholder. So that's growth stocks. You're looking to invest in companies that will really grow and grow rapidly versus, let's say, like income stocks. So if growth stocks are about reinvesting in the company and not paying out money to their shareholders, to their stock owners, to you and me, income stocks are the opposite of that. They want to pay a dividend, and that's the whole idea of your investing in them, is you want that income, you want that dividend. That's income basically coming into you that you can use any way you want. Maybe you want to buy more of that company stock. Maybe you want to buy another company stock or a mutual fund or invest in bonds or something else. Maybe you want to go on vacation or use it to help fund retirement or financial independence. Whatever it is, that's cash that's coming to you that's being paid because you're an owner in that company and you own that stock. And we'll talk about dividends and more and all that too, but that's the idea, is that you're going to get paid these dividends. You're going to be actually paid money by owning the stock. And that's what you're looking for if you're looking for income stocks versus, let's say, a growth stock, which is all about capital appreciation, the stock price going up. You're looking for, yes, you want the stock price to go up. You might hear of like mutual funds called growth and income funds, where they want some capital appreciation, stock going up, but they're also looking to grab that income as well too. And some companies, they don't grow as much. They're really all about income. So you still want that growth. You want that price increase, but you might be sacrificing some of that to get some current income now. And having dividends increase over time is also important as far as that growth phase. Not only stock, but you want your payout to increase over time as well. And that's a good thing to look for when you're looking at dividend stocks. And we'll look at about dividend growth rates and things of that nature, as far as over time. So let's say an example of a company like that would be, let's say, Coca-Cola, right? They make beverages like Pepsi, the competitor Pepsi. So Coke pays a dividend. If you own stock, for every share of stock, you get paid out on a quarterly basis a certain amount of money or a certain percentage of money that gets paid out to you as far as being a holder of the stock itself. So Coca-Cola would be considered like an income stock versus, let's say, like Google, which is totally a technology growth stock. Now, that doesn't mean that Coca-Cola doesn't want to grow. They definitely want to grow. They want to expand in new markets. They want to expand their product line by buying other types of beverages or creating new beverages or maybe getting to food and snacks or who knows what. They want to continue to grow their company and continue to grow their stock price. But they know people invest in them because they're not a high growth company. They're a steady growth company, and that people want to get income because they might be giving up some of that growth by not investing in more risky technology stock. They want to be in a less risky stock, maybe like Coca-Cola company, and get paid that income and get paid that dividend. Both types fit within a portfolio, right? You got small, medium, large cap type stocks, but then you have growth stocks and you have income stocks. You might want to have some balance between that, or weight one side a little bit more than another. So sometimes also with income stocks, the whole primary purpose is income. You'll see like utilities or things that might pay, things like communication companies or electric companies, natural gas companies, energy companies might tend to pay a little bit higher dividends or pay out that. And sometimes these people might think of income stocks as value stocks, and that's okay. I mean, the idea is you're paying for value, you're getting that regular value. But I look at, and we're going to look at the section on value, as more value of looking for underappreciated or underpriced type stocks. Could be growth or income stocks, but a lot of times you see value and income used together. So don't let that confuse you. Just understand that they could be a little bit different. Especially in mutual funds, you might see it where it says growth and value, and you might be thinking, oh, well, value, those are like, you know, what Warren Buffett invests in, and other folks, they want that underappreciated stock to buy it at a discount. No, really, like in the mutual fund world, they're really talking about income stocks. So do be aware of that. And that value is more of an investment strategy, more so than how you might bucket something. Because you can find undervalued companies, or value companies, whether they're growth or income. So income stocks, the whole idea behind that, if you're interested in those types of stocks or having that part of your portfolio, is they're going to pay you income. You might have some tax consequences of that because you're getting money now. But for people who are, let's say, want to balance their portfolio, or a lot of people are financially independent or retirees, dividend stocks are a huge part of that for them because they want that income coming in to help pay for their everyday needs. Is one way they can do it. So growth and income stocks. Now let's look at another type, which is kind of value. I look at things mostly from growth and income, but let's talk a little bit about value stocks. So as we break down this whole classification of how you can evaluate stocks, the different buckets they might fall in, or mutual funds or exchange trade funds, where they kind of fit, we're talking about like growth and income. And then the other thing under style that gets in there a lot is value. As we mentioned, you see that in mutual funds where it might say it's a growth fund versus a value fund, which really is more growth versus income if you ask me. This is my opinion on it when you're looking at it. Though, once again, with value, you see a lot of income stocks, dividend-paying stocks that get wrapped up in that, particularly in mutual funds. But a lot of times you hear about value being associated with purchasing of stocks, or fundamentals, or evaluating stocks. And the idea is that you're looking for stocks that are of value, as in underappreciated, underpriced. It's like bargain hunting, right? You go to the store or whatever, and you're looking for something that's on sale. Well, that's the idea of a value stock. How I look and how others look at this stock is on sale. And there's something going on with the stock that might have driven its price down. Maybe they had a bad earnings quarter, or they had a bad announcement, or said something, sales are going to start slowing, or something was happening in the global economy, whatever it might be. But you feel that they're underpriced, they're underappreciated, and that their long-term prospects are good. And you're kind of bargain hunting. You're looking for that great value, and you're looking for great companies basically at discounted rates. Looking at their things like their cash flow, and looking at their debt ratios, and looking at some things we'll be learning about as far as ratios, to look at what could be a higher long-term gain with that stock. A lot of times value stocks can have a greater risk. That's where they differ from income stocks, true income stocks. A true income stock is usually a larger company, pays a regular dividend. Maybe it's a company like Johnson & Johnson that's paid dividends for 50, 60, 70, 80 years. Companies have paid for hundreds of years of dividends coming out, so they're probably not very risky overall. But value stocks can be risky because whether they're a growth stock or a dividend-paying stock, the idea is they're undervalued. And maybe they're undervalued for a reason. Maybe they're struggling for a reason. Maybe they're about to go bankrupt. Maybe they are going to have a period of long-term decreases in earnings and sales and all that, and it might be a bad investment. So understand that a lot of times value stocks, they could keep going down that elevator. So be aware of that. True value stocks can have a good upside, but like anything that's risky with a high upside, it might have a higher downside as well. It just may be a dog and really never recover. So when you're looking at it from a style standpoint, think growth. For that rapid growth is what you're looking for. Price appreciation, income, where you're going to get dividends and get that regular quarterly money with some capital appreciation would be great. And value, you're really on that bargain hunt, and they could really fall in either of those styles, in my opinion. So just be aware of the differences between those. So the third way that we can break down where stocks, mutual funds, these different things can kind of hang out or be evaluated or separated from an overall diversification perspective. We talked about growth and income, or style that is. We talked about the size, as large, mid, or small cap. Taking both of those into consideration, now you can break it down by sector. And what we really mean by sector is what part of the economy does this company belong to? What area do they play on? What is their primary business? Think of it like this is the industry they're in. This is what we do. We're a retail sector, or we're in healthcare, or we're in financial, or we're in energy, we're in entertainment, whatever it might be. Think about, well, this is what they do. And it's important to compare companies inside their own sector and within their subsectors as well. Because if you compare, let's say, an energy-based company that might be experiencing slower growth, or a utility, for example, that might be government regulated, but you can still invest in, maybe get a dividend from. If you're comparing that to a high-flying technology growth stock, it's not going to be a fair comparison in either way. You might say, oh, that technology stock's terrible. They don't pay a dividend like the utility company does. And the other way, you might look at, say, boy, the utility company sure isn't growing as fast as that technology company. I want the capital appreciation or the stock price to go up faster and maybe take on more risk for that. So that's why when you break it down by sector, each sector might have or industry might have things that are, or do have things that are particular to that industry, and you want to compare companies within industry. Because you could have a utility company, for example, that might be very risky, almost like a growth stock within its utility industry versus others. Same thing maybe a little bit in technology or other fields. So when you're looking at things like ratios or fundamental analysis or qualitative analysis, evaluating the teams and all that stuff, you want to look at it within their particular sector or industry, and that's what we mean by sector. And then within sectors, you can have subsectors within that. I mean, you might think like, oh, well, retail is retail stores, right? I go buy stuff. Well, you have clothing stores, you have hardware stores, you have soft goods, hard goods. There's different ways you can even split those up. Like if we look at, let's say, healthcare is a good example of that, because healthcare is a good growing, I don't know about growing market. Certainly demographics are good for that. I like healthcare for a variety of reasons. One is the demographics. People are getting older. New medicines are being developed all the time. So healthcare might be an interesting sector to look at, for example. For me, it is, I know. So, but within that, it's like, what part of that sector you have? Pharmaceuticals, which is like companies like Merck or Pfizer, which make drugs. You have medical devices like Boston Scientific or Medtronic that make like heart stents and valves and different, actual devices that people put in their bodies to be healthier or to recover. And you have things like Amgen, which is a biotechnology stock investing in biotechnology. And then you can keep going from there, from managed care and life insurance to hospitals to nursing homes, all these different ways that you can break out that healthcare sector. So within that sector, it's not fair to compare, let's say, Merck, who makes drugs, versus Medtronic, which makes medical devices. They're different industries with different things. They're still within healthcare, but they share some similarities around government regulation, demographics, people getting older, all that type of stuff. But their competitors and how they should be evaluated are different. So it's good to not only look at the sector, but then the subsector after that would be my strong recommendation when you're looking at sectors. So sometimes folks will buy, let's say, a sector fund, for example. We're going to buy all the energy stocks or buy a certain portion of technology or retail stocks. So you can look at mutual funds or exchange trade funds can really look at the sector level. So if you think about it, it could be a growth and income stock, for example, growth or income, and it could still be within the same sector of healthcare. So they would be evaluated differently. So be aware of that when you're looking at them. And sometimes within sectors, it's hard to evaluate companies because they might fit really well in a sector, and other times they might play in multiple sectors and it can get a little confusing. So if we look at, let's say, for example, like Coke and Pepsi, they do lots of different types of side businesses and things too. But when you think of Coke and Pepsi, they're the two primary big competitors in the beverage market, in the carbonated beverage market. That's their direct competitors versus, let's say, an alcohol distributor or somebody like that. Coke and Pepsi, you can really evaluate real closely together. Or if you have a new company coming up, like a Jones Soda or somebody who's small, you can kind of compare that way. So they fit within that beverage area very well. Versus, let's say, if you look at like Disney, how do you evaluate Disney? Now you might be thinking to yourself, well, Disney, they have the parks, right? I can go to Disneyland Paris or Tokyo or Disneyland in the United States and California or Orlando, Disney World. You go to a theme park, you ride the rides with your family, it's fun, that's Disney, right? Well, and other folks might think, well, that's sort of Disney, but Disney's really all about movies, right? They own 3 big movie franchises. They own, recently, not too long ago, bought Star Wars from Lucasfilm, so they own the Star Wars franchise. They own Pixar, the folks who made Toy Story and those types of things, Frozen, all those types of animated movies. So they own Pixar, and they also own Marvel. So if you like Iron Man and the Marvel type comic superhero movies, well, that's Marvel is owned by Disney. So you'd be like, oh, well, they're a movie company, like Warner Brothers or MGM or somebody like that. They're a movie company. And they are, but then they do theme parks, and there's some relation between them, but the business for theme parks is probably really different than the business of movies, and they own these multiple parts. So how do you evaluate Disney, and what are you truly investing in? You're investing in the overall company, but understand those different parts of the company might make a difference. Maybe the theme parks are going great, but something has happened in the economy or in technology, like streaming of movies and things of that nature, of people staying at home more, watching movies on bigger, wider screen TVs from a technology standpoint. So that might hurt, let's say, the movie business in the future, but maybe their theme park business does great. Or maybe vice versa, something happens with the theme park business, and Universal Studios opens up more places, and a direct competitor of the theme parks for their theme park business. So all those things you would take into consideration with that. So even within sectors, it's kind of hard to evaluate within there. And then companies tend to move in concert within their sector. Not always, some outperform, some underperform, of course. But if you have an entire sector that, or an industry that's suffering, they're all going to kind of suffer together. They'll all kind of pull each other a little bit down, versus one that might be rising. Rising tide lifts all boats. So a lot of times you might see where things might follow along. It's not exact, but just understand that sector can impact even good performers. If a poor performing sector could impact a good performer within the sector unnecessarily, which might be a good value opportunity for the long term, by the way. So if we look at, let's say, something like the Vanguard Energy Index, which looks at energy companies, you might see that how that index compares to the wider S&P 500 largest companies of all different types of sectors. Might be a little bit variance, but if you're Exxon, an energy company, and you're part of that energy index, you're going to tend to move in concert with the index, and maybe not as much in concert with the overall S&P 500 fund, but even still, all those things go together, especially now that we're in a more global economy. Things will tend to kind of go together a little bit more than maybe in the past, where you could have one sector just do tremendous and another sector be bad, and the overall economy is bad, but somebody's standing out. You always have maybe some of that, but it's harder because everything's so intertwined now. So things to look at. So when you're thinking about your diversification and when you're looking at your overall stock portfolio, keep that in mind too. Maybe you've been buying dividend stocks and you like income from it, but you might look and say, oh my gosh, all my dividend stocks are pharmaceutical companies. Johnson & Johnson, Merck, Pfizer, all these different big pharmaceutical companies, and I'm missing out on small and mid cap. I don't have anything in other sectors, and maybe I'm at risk around things like regulation around pharmaceuticals that brings everybody down. And then I'm like, oh, I'm exposed myself to more risk because I'm only in that one sector. So when you're looking at your overall portfolio, these are three big areas to look at. Look at the size, small, medium, large cap, the style, growth, income, maybe it's a value opportunity, and then the sector and the subsector, and understand where you can push to one side is great to get a bigger return, but you want to understand the overall impact of the different diversification, the different things that you own.